right into a new investing year amongst all the other things that we do in our lives. So we're going to start off by looking at the markets, and then next week we'll do a portfolio considerations webinar. And then the week after is going to be another webinar in stock for you as well. And so we're going to start off with 3 Wednesdays in a row. Right, what's up with the markets? We just need to have a look at some reminders. So just want to remind you that none of the stuff I do here, and this is particularly for new members, is used in SPA3 Investor, either in the research or in actually the trading of live portfolios with either SPA3 Investor or SPA3 Trader. And also, I don't use any of this analysis that I do here today to make my own decisions. This is, for me personally, really just a big picture overview of what's happening in the markets. And most of you will know that I do an even bigger picture, which is the secular bull market update, which we do every 6 months or so. But this is just doing a monthly update of looking at where the markets are. But none of this is used to make any decisions in the public portfolios or in my own personal portfolios that I run of SPA3 Investor as well. And I'll state again, I'm a totally 100% mechanical trader, have been for decades, and I precisely follow our systems with my own money. I don't use any other systems. That's another question somebody asked. Do I use any other systems outside of these? No, I don't, but I do continue doing research, and you'll see a little bit of that come through today and what we're looking at. So before we get into it, everything we covered today is of general investment advice, and there's no specific investment advice in everything that we cover here today. So let's get straight into looking at the markets. That's what we're here for. And we'll start off with the Dow Jones. Yes, we are. And Dow Jones has actually given a sell signal during the break. Let's just zoom out a bit over here just to give perspective again, to remind us all. There was a sideways moving market here for 2.5 years in the US, had a breakout, came down, retested, and now we're well and truly above this previous high over here. I'm going to keep that black rectangle. I use that to show where the previous high was, just to give some context of where the markets have been and where they're going. Because remember, sure, it's nice knowing where we've been, and we know that we don't need to know what's going to happen next in order to make money. That's Mark Douglas's fundamental truth number 2. Those of you that are doing the Learn to Trade Properly, the 2 groups, would have had that, and also have done the 4-week training intensive, would know a lot about that. In fact, the people doing it, I see some names on here of people who are doing the LTTP, the Learn to Trade Properly courses or cohorts or groups, and we've had some fantastic feedback of people recording themselves, repeating the 5 fundamental truths by heart, and what they do every time they do a trade. Anyway, back onto a bit more about that later in the session. Right, exit signal here. So indecision happening, underperforming the S&P 500. So this here is a positive. I'm looking bottom right. That's positive in terms of taking risk in the market. If the Dow Jones is underperforming the broader market, the S&P 500, that's typically risk on. So this bit of weakness in the Dow is nothing to worry about yet. What I'm keeping an eye on here is the longer and shorter term retracements of this run up over here. So what we're seeing, the magenta line over here is the 23.6%. Sorry, it's not that one. It's this one over here. 23.6%. What we're keeping an eye on is how deep this retracement is, and we haven't, on this total run up over here, we haven't yet exceeded the 23.6% retracement, which is bullish. On this shorter term one over here, we have had a 38.2. That's the blue line. We're right on the 38.2, and that's pretty short term. So obviously the amount that it's got to fall is not that much. So well within our bounds here of continuing with the market continuing to rise. So there's no, from a generic technical analysis perspective, there's no alarm bells going off. Similarly, with the S&P 500, sure, we've had some sideways movement. We had a little bit of volatility starting to increase over here, and that's because of this bar, the big bar over there, would stay in this 21-day ATRVE that we look at. So percentage-wise, jumped up to 1.3%, still relatively very low. But the key thing is here, we're above this. We've this all-time high over here. Retracements are shallow, and you can see that we haven't yet had a 23.6% retracement of this run-up from all the way back here, which is October 2023. So some 15 months ago. And this one over here is at even a shallower retracement, which is why we're getting outperformance on the Dow Jones than the Dow Jones. It's only a 23.6% retracement. So it is at this stage, it's looking pretty much like a market should look. There's no signs here of any of divergence, basically going in the same direction, although a little bit of drop off in the new high, new low breadth of market indicator, and the cumulative advanced decline. Also a little bit of a drop off over here. So more stocks are declining than rising, but there's no divergence. We've actually had lower highs on the index as well. Another breadth of market indicator, number of stocks above their 150-day moving average, and you can see it's dropped below the 50 percentile here. So the midpoint, the median, if you like. And we have had a drop off, lower highs in this, so falling away. There was divergence there, running up to this high here, but now we are going in the same direction. So no divergence of recent, but over there, which is a little bit of a bearish signal. So breadth of market starting to has been weakening. Okay, looking at the US dollar, let's just we've had an exit signal here. Why is that? That's because we've got this is a relative strength line. So this Siroc over here is measuring the rate of change of the relative strength comparison. So the strength, but we're measuring the difference in strength between the two, the S&P 500 and the US dollar, and we can see that the US dollar is strengthening relative to the index. And typically, when US dollar rises, we are going to see weakness in stocks. So that's what's happened here: rising US dollar over that period of time. And guess what? The stock, and all of these lines I've got over here are showing where that happens, where US dollar weakens, market rises. Where US dollar strengthens, then we get the market having a bit of weakness in it. So that's what that sell signal over there, and it's one that we should watch. A high correlation here. So maybe that's the first, if you like, bearish or negative sign of what may be to come in the market. Of course, the US dollar starts to weaken, and this is measured against the basket of 6 currencies. It's not just against one currency, and then we might see what happens after that. So it is a good indicator on short-term market direction. Right, looking at the Russell growth versus the Russell value. Growth here, the top one, just by the naked eye, you can see, and I know I keep saying that in these sessions because it is obvious. Yeah, it's not always obvious. Is that we got the growth index rising, and this is the Russell 1000, so 1000 stocks, and you can see that the value is falling. Relative strength line rising. This blue line rising is saying that growth is outperforming value, and I've put a smooth index rate of change indicator on that, the Siroc, and we've got a green line there. So growth is happening. So that's obviously bullish. And then we look at consumer discretionary versus staple. Very much the same thing. Discretionary rising. We've got our smooth index rate of change indicator here on the relative strength line. Relative strength line is rising. So is the longer term moving average. I've got what have I got on the 55-day moving average rising. And you can see the naked eye that staples is falling. So that is another bullish sign. Looking at the put call ratio on equities, we've got a broadening top over here. Sorry, shouldn't say a broadening top. We've got a broadening formation. We're getting higher highs and lower lows. And you can see that happening here just on the right-hand side. However, we are still seeing this lower lows. We're still seeing there are more calls than puts, even though we've had some weakness. And that's probably what this volatility was over here. And just looking at how this resolved itself back here was certainly, we had the market continue to rise. This is the S&P 500 down the bottom over here. So this is also bullish. Investors aren't running to puts at this stage. Right, looking at the short-term, looking at 10-year T-bond, this is yields. We've got what we call a sell signal over here. Why is that? Yields are rising. So when yields are rising, it typically is bearish for stocks, and we have seen yields rising again, and hence we have seen bonds falling. So this is the 20-year Treasury bond, and we see that falling. And typically markets and equity markets and bonds move in the same direction, but not always. As you can see here, we had bonds falling and we had market rising. So the correlation between the yields and bond yields and yield prices is not as high as the correlation that we have between equities and the US dollar, or the opposite thereof. So it is a sign of a little bit of weakness, but let's keep an eye on that. Volatility did spike back here on that was in the middle of December, but we've seen it come down to pretty much lows below 20, around about the 17 mark. So that is pretty low. We have had a sell signal like we do on the Dow Jones. So we have an open trade on the S&P 500. We have a closed trade on the Dow Jones, and we have a closed trade on the NASDAQ as well. So let's keep an eye on this. We still do have outperformance. That's the blue line rising over here relatively. The NASDAQ is still outperforming, although it's flattened just here in the last couple of weeks against the S&P 500. And that is why we've got a smooth indicator here, which is an indicator of the relative strength. So a little bit of an early warning sign, if you like, but these happen all the time. It doesn't mean that the market's going to collapse in a heap, but we just keep an eye on it. On the NASDAQ 100, there's a bit more room over here. No sell signal on that. And that is also a risk on. We've got the relative strength is telling us that we are outperforming the S&P 500, although similar to the NASDAQ composite, flattening out a bit over here. So that's certainly one to keep an eye on, is the relationship, the ratio between the NASDAQ indices and the S&P 500. Right, on to breadth of market on the NASDAQ. We don't have any divergence here, so no early warning signals there, nor do we have divergence on the cumulative advanced decline line on the. So what I'm looking for by divergence, I'm going in different directions like we have over here. We have there's divergence, rising index, falling advanced decline line. At the moment, they are both falling and going in the same direction, which is what you'd expect. Okay, breadth of market on the NASDAQ here as well. NASDAQ 100, using the number of stocks above their 150-day moving average. There was divergence there, taking us through to the middle of December. And now there's no divergence, both going in the same direction. But this early warning, if you like, it happened there where the peaks were basically the same, but we had falling breadth of market, number of stocks above their 150-day moving average. So this, if you like, bit of weakness has been showing up in the NASDAQ since the middle of November, but hasn't yet transitioned into anything serious, because we did see the index, this is the NASDAQ 100, continuing to rise. So some early warning signs. That's why we do these sessions, just to get a feel and get some context and perspective. And that is certainly showing that that is the case. Now, I don't think we have data. The data for the stocks for the semiconductor index does come in a bit later, and that's missing a bar there. So that is we haven't seen what that is. So that's basically the session before. But still some underperformance. We've had underperformance of the semiconductor index v the NASDAQ 100. So that is why we've seen a declining relative strength over here. And of course, I'm going to have a look at some stocks in a moment, which are the AI stocks, if you like, which are the ones that are probably representative of this, constituents of this index, just to see how they are going. Because that's what everybody's talking about. So I thought I'd cover it. But this, there's been underperformance here for quite some time by the semiconductor sector. So going all the way back to, what is that? That is June. We've had this underperformance. So a raging bull market, you will see this sector, which should be outperforming the NASDAQ, which would be outperforming the S&P 500. And that is a really risk-on environment. So we find ourselves setting up now for just looking at the stocks. I'm going to look at it in a moment. A little bit of no man's land. There's been a lot of noise out there about the AI stocks have had it. They've topped out, and they are, it's now people, as you've seen me talk about in the secular and a couple of webinars I've done, is that there are these people who are not typically perennial bears are talking about this, a big picture view of doom and gloom. So this is playing out, if you like, and the commentators are watching this. they've got negative comments on the AI and the semiconductor and the typical technical stock. The stocks that are the IT stocks that are typically the ones that everybody's in when the market is raging. So this bit of sideways movement that's been going on, struggling around this all-time high over here, which is why I've got this dotted rectangle here. Arm wrestle going on above and below. On the Monday session in the US, there was a strong jump up, a gap up that hasn't followed through. But this is certainly one, if you want to get a bellwether on equities and which way they break out, keep an eye on this one. You can see there was some relative strength just rising over here into this webinar that I'm doing now, but over the last couple of weeks. But we want to see this really rise up and relatively this blue line over here start rising, but we've got the smooth indicator over here to give a signal, something similar to this back here, which was back in December 2023. So that's what we're looking for a real raging bull market, risk on environment. And it's not there yet, but this is certainly a bellwether to keep an eye on. And on the flip side too, if this falls away strongly, that's going to be because of the stocks we're going to look at in a moment, are the constituents of this index, and others, smaller ones as well, will have obviously a negative sentiment towards it, and that could lead to the whole market having a bigger retracement. Right, onto the all ordinaries. The Aussie Battler underperforming the S&P 500 typically happens in a risk on environment. Exit signal there. So this is another index that's given an exit signal. It is struggling long, had a couple of good sessions, but it's below theirs. It's all-time high over there, nowhere near as far above that all-time high, going back to August of 2021, back there, or it might be back there, or might even be back there. Nowhere near as far above that all-time high. So relatively underperforming, and that shows us in this blue line, which is falling away over here, a relative underperformance to the US market. That's against the S&P 500. That's a relative strength comparison. So looking like it might give an entry signal, but it depends on what's happening in the US. Okay, onto the Aussie Battler. A lot of weakness, come from nearly hitting 70 cents all the way down into the high 61s as a low there, and trading in the 62. So that is a big sell-off in the Australian dollar, or but more so on the strength that's relative to the US dollar, but strength in the US dollar against the basket, which we saw in the earlier chart. So Aussie Battler certainly battling at the moment. International stocks, the Nikkei really wrestling with its all-time high. That's the black line over there. I put a single black line which goes all the way back to 1989. And it's above and below, and then it's classic buyers v sellers in this market while it resolves what to do. And while it's been doing that, it's been underperforming the S&P 500 while it has its own little struggle in Japan over there amongst all those stocks. Right, the DAX has started showing some strength again, a little bit of weakness against the S&P 500 getting above. Now, this all-time high is that I put there's a black one. This is the all-time high that is relative to the 2000 to 2013 secular bear market. So that is the secular bear market there. There's the breakout around about April, when was that? That was a bit later. There's 2013, June 2013, a couple of months after the US markets. And now we're above so I've kept that, but this is a new all-time high that I put in there. And again, strength above that. So the DAX is doing well despite the negative German economic situation that they're not enjoying there, but the market is doing well, looking to potentially make another new all-time high, not far off it from the one it made in mid-December. So strength there. Not so in the FTSE. This here is the secular bear market, sideways moving market, and it's had to try to break out, fall back into it, broke out again here, and it's still not making much headway outside of that secular bear market. So you could almost say when the FTSE fell back here in February of 2020, and then it took until June of 2021, it was back into secular bear market territory that it started back in the year 2000. So a lot of weakness in the UK. Okay, let's have a look. One more market, the Bovespa. Sorry, we'll look at a couple more Bovespa and the Chinese markets. Bovespa is above its secular bear market high, but really struggling here. This has been going on since June of 2021. So 3.5 years of sideways and underperforming US market and even underperforming the Australian market as well. Okay, the skyscraper that occurred in the Chinese market looks like it's turning into another skyscraper, falling away. Lower highs, hasn't had low, it had lower lows there, but they did make a higher low on that one. But this is the top 50 stocks, so that's the large cap stocks, and the wider Shanghai All-Share Index also turning into a skyscraper as well, which is a characteristic of the Chinese market. So weakness there. And lastly, the South African market is above. It's there's the secular bear market back there, sideways, but it's now in the massive sideways movement. It has had a new breakout, but showing some weakness above that breakout. So just summarizing those markets, there are some early negative signs, early bearish signs, but with more in breadth of market than anywhere else. But breadth of market, not every bear markets, not every weakness that there is from a breadth of market indicator leads into a bear market. But they typically are there when they do follow through, turning into a bear market. So it's not one to rely on, but we do look at those early signs to see where they're going. Right, let's just quickly now look at commodities, and I'll start off. We'll just go to gold. Gold is in a bit of a down market, lower highs, and although that was higher lows there, they haven't really taken out the lower lows, but we've got a down trend over there. And it's to be expected because they had a really good breakout. Similarly with silver in a downtrend, oil in a downtrend, and so is sorry, that's not oil, that's copper. Copper's in a downtrend, and oil's in a downtrend as well. So commodities showing weakness. However, Bitcoin is showing some strength, and there's the breakout above the all-time high, and it's now having a retracement. So but this run up to above $100,000, big round number. Expect the participants in the markets to always find some resistance and sell out at big round numbers. So it's pretty short period of time from when it did get above $100,000 to current. So it's just keep an eye on Bitcoin, but there's more strength there than weakness. This retracement is very shallow, as Ethereum has not quite followed through above its all-time high, but the Bitcoin is leading, besides all the little tiny small market cap crypto, is leading the way. We'll just quickly look at uranium. Uranium has fallen out of the channel and is showing weakness here. So that is and is following through into the ETF as well. Weakness also in iron ore, but strong support at this level over here around about the $95 mark. That would need to hold. You can see this support and resistance has formed quite a strong support resistance base there around about 95. And thermal coal also forming that base which we've spoken about. You can see these take long periods to form. This now is going back to June of 2023. So this is 18 months it's taken to form that base, and we'll see where it goes from there. Of course, if it falls out below, it's not a base. If it rises above, then it is a base. Okay, now what I'm going to do very quickly is go through some stocks. So just summarizing the commodities, there's more weakness than strength in commodities right across the board. And so what does that mean? Well, that means that the smaller to mid-cap stocks, and I'm not going to go through it now, but you can do it in your own time. I've updated the charts. You can look at the small resources, mid-cap resources indices in your instance and beyond charts, and you'll see there's no strength there at all. So that is the smaller side of the Australian market is not getting time of day. Obviously, there's always going to be one or two exceptions here and there based on news and noise and themes and memes and whatever. But overall, the small caps, the mid-cap resources, small cap resources are not doing well. Emerging companies not doing well in the Australian market, and we can see why with the commodities. Right. And of course, not much to comment there on the US markets because that's not a big sector in small and mid cap resources. Right, let's go to, I wanted to cover some stocks, AI stocks. I've set up a new watch list, which I've called AI stocks, and this is in the US, just to get an insight into what's going on with these stocks. So the first one, and they're basically in market cap. There's some that you'll know and some that you won't know. Starting off with Microsoft. Microsoft, there's its all-time high there, which was reached back in November of 2021, steep retracement, 61.8% retracement, which is quite steep for Microsoft. That happened in 2022. We know how that translated into our US portfolio and obviously into the market as well, but a really strong run up from there since. Now, where is it at the moment? Well, it is above its all-time high, but it has found that previous all-time high, but it has found resistance. So there's a bit of a trading band, a sideways moving rectangle, if you like, which is typically a confirmation. Sorry, it's a consolidation of the trend going into that wide ranging, if you like, rectangle, and typically it resolves itself by a breakout in the same direction as the price leading into that consolidation period. But it is quite wide ranging and quite long. So it is an open trade at the moment on SPY3 Investor, and the first signal would be, you can see how this kind of the exit line, the trailing stop line over here, fits in quite closely with the support zone, which is obviously an eyeball subjective choice of that, but it's there or thereabouts. So this is a positive. So Microsoft is rising and is an open trade. The next one to look at is Nvidia, also an open trade, and then just going sideways, finding resistance at its all-time high, snuck above, and then a big down day on the markets today, and in an uptrend, a very strong uptrend. And if you look at all the fundamentals, people would say, why would you be in this? But we just look at technicals, and so keep an eye on Nvidia. This sideways moving market been going since June of 2024, so about 7 months, 6 months old, and resistance there. So we're looking for, and I could also put in here a support zone, which I would put in there. So I'll leave some of these for us to look at, and you can hopefully learn a little bit about technical analysis. But that would be the sideways moving, broke into this here, came down, found support, and then rose into finding resistance. So a long way from that support zone, but if it did give an exit signal, that's where we'd be looking at. So this is, whilst Microsoft is positive, Nvidia is more positive than negative, but certainly not shooting the stars out. The next one to look at is Google. Google has made a new all-time high over the last couple of weeks, is an open trade as well, but also moving in the sideways moving market. We need to confirm this breakout. This is not, I would say this is not confirmed yet. It's come down and tested, and we need to see this price to confirm this using just generic technical analysis. Obviously, from a mechanical perspective, it's confirmed an open trade, which started in the midway through in this range over here, which happens more often than not when you get really good juicy trades. They don't all happen at the breakout. They start a bit earlier in the sideways moving band. But to confirm this, we'd want to see a sharp rise, then form a 3-day peak. How would we do that? You'd go to swing chart, and you can see, and I've just got this set up. This is a 3-day swing chart. There's the higher high, the breakout, come down, test just below the previous, a lower high, and then a higher low. And now what you want to see is a 3-day swing chart confirmed, which would be a rise above this. And then, so we haven't finished the swing up yet. You can see that. And the next swing would be confirmed when you have a 3-day low, and we want that peak to be higher. And also the next test after that to be above this. So Google is showing a bit more positive signs in Nvidia. Will Nvidia have the same price action that happens in Google? Well, we'll have to wait and see. Right, on to Amazon. So Amazon has, this is a classic, what will explain what I was saying earlier, and where there's the side, there's the peak, the previous resistance zone, rise, sneaks above it. And now, well, how do I know it snuck above it? What I do here is I put the top of the line on the close, so that you'll see the close is right below that over there. There it is. I'll just go back to it. Whoops, cancel. So that's where I draw the actual the resistance zone on all of the charts. So hopefully there might be one or two that have slipped because of whatever reason. So that's highs and closes rising above that previous high close there, falls back into the zone, breaks out again, and now we have this clear breakout. And that's what could happen with NVIDIA for a while. Obviously, we're looking at a shorter time frame than this, but we do want to see that strong breakout for that confirmation of the AI stocks, if you like, which is what everybody's looking at as the barometer of where the market's going to go over the next few months. So we've had this is an open trade, a much better open trade for Amazon. The public portfolio I don't think is in Amazon, but the unleveraged one isn't. But this hopefully some of you are pretty juicy trade here at the moment. You've got a stop now right up over here above that previous high. And also just I could go into the Fibonacci's. You can do that in your own time. We are running a bit out of time, but you can see where the Fibonacci's give you a good indication looking back as to the characteristics of particular stocks. And you can see this here of that run up it had there was a 38.2, which is just like textbook stuff. When you have 38.2s and then the market and then the price action moves above that, that's a good enough retracement for a bull market environment to then continue rising. Obviously, in bear markets, you'd see them go sideways more and have steeper Fibonacci retracements. So this is all textbook stuff that's happening in Amazon, and it's near all-time highs as well. Right, Meta, which is not as part of SPA3 Investor, but it's getting pretty close to being there because we've got the history, we've got the volatility, we've got how do I know we've got the volatility? There's the volatility, that's the 3.5 line of percent ATRVE, and there's plenty there. So we'll be adding Facebook to SPA3 Investor in the not too distant future. So it meets trendability, volatility, liquidity, everything. It's right in there. And we've got the 10 years being met now as well. So we are going to add that to the list. But where is it now? Well, it's above its highs. It's really is in an uptrend. I could add to this an ATRV. Now that's just a generic one I use typically for these stocks. I'd have a wider, just to give you a little bit of an insight. I'd probably go a 5.5 to start with, and then see where it goes from there. And that would give you an indication of the ATRVs. This is not set up like we have in SPA3 Investor, where it's got different volatility zones. This is just one volatility zone right across the board for that indicator. But if we did use that, it would be an open trade. So Facebook, very close to all-time highs, is positive. That's positive for what we're looking at. The next one to look at is TSM, Taiwan Semiconductor Manufacturing, also above its all-time highs. I've put on an ATRVE. It's not part of SPA3 Investor, but we've got plenty of data here. It's volatile enough, but it's become more volatile as it's become it's seen as an AI stock, if you like. And there was a period of time here where it was lower volatility, plenty of data, and plenty of liquidity, turning over, 2.5 billion a day. So we can look forward to this one also meeting the criteria to be added to SPA3 Investor. And what is it doing now? Well, it's an open trade just on I think this is a ATR 66 I've put in there. So that's an uptrend, and you can't deny that. So there are these other stocks, large liquidity stocks, large cap stocks, which are doing very, very well. Right. Okay. Let's go down to the next one now. This is ASML Holding. This is a supplier to semiconductor environments, not doing well. It's considered to be one of the AI stocks to keep an eye on, and that's down. So there's one that's not doing that well as a supplier rather than a supplier to AI rather than being AI. Adobe is also not doing that well either. It's considered to be an AI stock in a downtrend. Had a big sell-off over there, that's one that's not for the case. IBM, interesting on IBM. Let me just look at, so that goes back to 2020. I've got data on IBM. If you just bear with me, I'll just go to home chart period. Let's just go all data. So we've got data here going back to 1950. And IBM has just made an all-time high ever in its entire life. And that's a log chart, obviously. And you can see there's many years of it going sideways. And that's effectively what it's done. It's gone sideways for many, many years. This has been when was that? That was, what's the date here? We've got a date of 2013. Is that right? Yeah. 2013 was that last high. So we've heard you talk about secular bull market starting April 2013 on the NASDAQ. NASDAQ was a little bit later, the S&P 500, and IBM's been in the doldrums all the time. But now suddenly, and that retracement there was, what was it? That was quite steep. That was a 55% retracement there fall, and now it's had a breakout. So IBM hasn't been in our list, and it might be time to add it. Let's have a look at liquidity. Whoops is doing liquidity on all 55 years. There it is. You can see it's starting to rise a little bit. Maybe not, but certainly the trendability is there. I'm just going to cut the period back to 25 years. Just makes the analysis go a bit quicker on the rest of the charts. So it's had a breakout, and that is one that we could potentially look at. But as an AI stock, and it's seen as one of the lower level ones, not right up there with NVIDIA in terms of profile, but it's got positive sentiment towards it. Okay, and the last one to look at is Arista, and I've put no analysis on here. It goes back to 2014, and so I will just quickly take you through now what part of what I do to decide whether a stock should be part of Aspire 3 Investor or not. So I'll do this live. I've got my favorites here. The first thing I'll do is look at volatility. Well, first of all, date. So we've got 10 years of data, tick. Volatility, you can see that the volatility on this is far greater than, say, let's go back to Microsoft, and we'll put volatility on Microsoft, ATRV, and you'll see Microsoft, we've got data going back to 2000, spends most of its, the ATRV, which is measured as a percent of price. So it's the ATR, the average true range, divided by the price, and then that works out a percent. And you can see multiplied by 100, and you can see that it's pretty low. It's 1.99 at the moment. So if we go to Arista, oops, where is it? That one. And we put the ATRV back on here, then you will see that we are spending a lot of the time above 3.5, and at the moment it's 3.38. So it's probably nearly, it's not double, it's about 75% more volatility than Microsoft. So then the next thing we look at is liquidity. Now, we want the liquidity to have been high enough for most of the 10 years. And if we go back and we look right back on the left over here, we'll see that the liquidity was running at about 3 million a day. So that's a little bit low, but over here, it's running at 349 million a day. So here back in 2018, it got higher. And so in terms of our back testing, this would probably just meet the criteria, and we could then run this. So this is potentially a stock we can put on here. And now I do my analysis. How would I do my analysis? Well, I'm looking for areas that are support and resistance. It's the first thing I do. When was this period? This period was 2018 through to 2020, thereabouts. And I'll do the same just to get a bit of a channel go, if you like, a sideways moving band, and we'll save that. Now, how do I draw the trend lines? So trend lines, I would do I'd then do Fibonacci's, which I won't do now, but I've done this before, and I'll show you quickly how I do trend lines. I'll try and get a lower, what I call a spine. So the spine, we'll do a red, thick red, and the spine I would put right going back to 2020 here, and we would get the midpoint. So this is like the median point, and you want as much data being above the median point, the midline, if you like, as you have below. So somewhere around that would be a half decent spine. You want to try and touch points over there, and then you simply do parallel, and there's your upper, and you'd be amazed at how often the touch points are pretty actually touch peaks along the way, and you'd also be amazed at how often this touches on the. There we go. So that's the price telling us what the channel is, and then I would make this I'd make this a dotted line or a dashed line, and then I'd save that. There you go. And there's our channel. So what this is telling us now, just relative to past price action, is that this price action is pretty much close to the top of the channel. I would then also put a ATRV on it, and being a little bit more volatile, I would probably change this to just make it 6.6, and then you can get a little bit of an idea of how well that works. And the first thing I do now is go and look at not the positive times, but the negative times to see how well that works. So there you would have got an entry, lost trade. There you would have probably broken even, or maybe just got slight positive. There was a big gap down, and kept you out of this period over here. Probably a little bit of a lost trade there, a little bit of a lost trade there. But then what you want to capture are the uptrends. So you want to keep the lost trades to small and the rising to big. There I kept us out over there pretty nicely when it didn't make a new high, and then captured the big juicy trends along the way. And here's one where you could go, okay, give it a little bit more room, and then you play around with it. But we do all that programmatically. But the reason I did that now, it's an open trade. So now, just because I'm going to finish up now, is looking at those stocks and just going back to the talk of the town, if you like. We'll just go to Dow Jones and S&P 500. Oops, and we'll just finish up looking at the S&P 500 again and see where we are with that. So that's an open trade. A little bit of lower highs over there, no lower lows yet, but all in all, looking at these indicators, looking at the breadth of market and the sentiment indicators, is that this is still risk on, most definitely risk on in the US market and Australia, even though Australia's given an exit signal at this stage. But of course, as mechanical traders, we follow the signals and we try and keep our money in the market as much as we possibly can. Now, I saw some comments in the chat, didn't see any questions. I'm going to end it there. Thank you for your time. Happy New Year again. And we will be back in a month and do this What's Up in the Market session. But next week, I'm going to do a portfolio consideration session. And the week after, we're going to do a bit of a training session and just let you know a little bit about what other training we've got coming up pretty soon and later in the year. And we would like to get as many of our customers as possible to attend that training. But I'll make all those announcements in a couple of weeks' time. So thank you for your time and attention. And I wish you consistent and objective and peaceful active investing and trading.